You know that feeling of getting paid?
Yeah.
Imagine that happening regularly, not just from your job, but from the stocks you own.
Mm-hmm.
That's really the promise of dividend income. And if you're like, well, many people we talk to, building that kind of consistent cash flow is a big goal.
It really is. It's a powerful idea. Your investments actively, contributing to your financial well-being
Right.
through regular payouts, right?
Well, in this deep dive, we're going to get into the nuts and bolts of how you might identify stocks that have a solid track record and, well, the potential to keep those dividend checks coming.
And we'll be focusing on insights from a really informative YouTube video. It's from Pushkar Raj Thakur, the stock market educator. The title is Regular Income from Stock Market High Dividend-Paying Stocks List.
Exactly. So our aim here is to take the sort of practical steps outlined in that video and really understand how to spot potentially good dividend-paying stocks.
Yeah.
But, and this is really key, we want to help equip you to do this thoughtfully, so you're not just blindly chasing after the biggest dividend percentage you happen to find.
Precisely. Because a high dividend yield flashed in big numbers, well, it isn't necessarily a sign of a healthy, stable investment. Not at all.
Okay, let's unpack this a bit.
Hmm.
For anyone tuning in who might be maybe newer to the dividend game, what exactly are we talking about when we say dividends?
So, in simple terms, when a company makes a profit, its board can decide to distribute a portion of that profit back to the people who own its shares. That's you if you hold the stock.
Right.
Think of it like a little thank you for being a shareholder. These payments usually land, directly in your bank account, often quarterly.
Sounds like a pretty sweet deal, doesn't it?
Mm.
But this is where the video makes a really crucial point. Don't just type high dividend stocks into your search bar and pick the one with the biggest number next to it.
That's a fantastic way to put it, yeah. The video uses this idea of, I think it was cold India. Seeing a stock with a juicy-looking, say, 5% dividend yield
Yeah.
doesn't tell you the whole story.
Right.
There are other really important pieces of the puzzle you absolutely need to consider.
Which leads us nicely to the idea of dividend yield itself.
Mm-hmm.
The video actually breaks down how this is calculated, which is helpful.
Yeah, it's a pretty straightforward calculation, basically. You take the total amount the company pays out as a dividend per share over a year.
Okay.
You divide that by the current price of one share of the stock, and then you just multiply by 100 to get a percentage.
Got it.
So the video gives a clear example. If a company pays out, say, €4 per share annually, and its stock is currently trading at 100,
Right.
then the dividend yield is just €4, 100, which comes out to 4%.
Okay, 4%. And according to the video, generally speaking, a dividend yield above 2% is often considered a decent starting point.
It can be an initial indicator, yeah. But the crucial thing to remember, and the video stresses this, is that it's just at a starting point. Relying on this one number alone can actually be quite misleading. We
Yeah.
really need to look at the bigger picture.
And the video gives us a framework for doing just that. It talks about what it calls a customized formula for potentially identifying good dividend-paying stocks. Okay, let's dive into this formula. What are the key ingredients here?
All right. So the formula from the video lays out several criteria. First, as we just discussed, the dividend yield should probably be above 2%.
All right.
Second, the company's dividend payout,
Right.
ideally at 100%. Now, this one's less common, and honestly, if you see this, it's worth digging deeper to understand why they're paying out all their profits. Is it sustainable? That's the question.
Good point.
Third, the profit growth of the company over the last 3 years should be higher than its profit growth over the last 5 or maybe 7 years. That suggests some, positive momentum recently.
Right, acceleration.
Exactly. Fourth, the average dividend the company has paid out over the last 5 years should be above 0, basically, showing a consistent history of some kind of payout.
Makes sense.
Fifth, the information on both the last year's dividend and that average 5-year dividend should be readily available for you to see. Transparency. Mm-hmm.
And finally, number 6, the company's profit after tax should be greater than its net profit in the previous year, showing growth there too.
Wow, that's a pretty thorough checklist. And the video also highlights that you, the listener, can actually take these kinds of criteria and build your own custom filters on stock screening websites, right?
Absolutely. That's a key takeaway. These screeners are powerful tools. They let you input specific financial metrics and instantly filter through like thousands of stocks to narrow down your search to companies that meet your specific criteria.
Okay. Now, moving beyond this initial custom formula, the video really delves into some Important financial metrics. These seem essential for a deeper fundamental analysis when you're looking at dividend stocks. Let's start with ROCE.
ROCE.
Right.
It stands for Return on Capital Employed. Basically, think of it as a measure of how effectively a company is using all the money that's been invested in it, that's both from shareholders and through borrowing to generate profits.
Okay, so overall efficiency. Exactly. The video suggests looking for companies with an ROCE, preferably above 20%. On the flip side, a low or negative ROCE is generally seen as a warning sign.
Right.
What's interesting here is that ROCE really gets at how efficient the underlying business is at making money. And that's a key indicator of its ability to potentially keep paying dividends down the line.
That makes a lot of sense. What other sort of financial health indicators should we be paying attention to? The video mentions net profit, but specifically quarterly net profit.
Yes, taking a look at the company's net profit in the most recent quarter gives you a more current kind of snapshot of how well it's performing right now. Consistently growing or healthy quarterly profits are usually a good sign that the company's core business is, well, doing well.
And then there's the PE ratio, price to earnings ratio. This is a pretty common one, isn't it? A lot of people might have heard of this.
It is. It's a very widely used metric. The PE ratio essentially tells you how much investors are currently willing to pay for each rupee or dollar of the company's earnings. It's often used as a way to gauge if a stock is potentially overvalued or maybe undervalued. The video points out that a lower PE ratio, especially when you combine it with a good ROCE and a healthy dividend yield, could suggest an attractive investment.
Hmm.
They even give an example. I think it was a stock with a PE of 12, an ROCE of 20%, and a dividend yield of 3.27% as a company worth, further investigation.
Interesting. It raises that question. Could the market be overlooking a company that's both profitable and pays a good dividend?
Exactly. That's the kind of thing these metrics can help you uncover.
Okay. The video also briefly touches on ROE, return on equity. How does that fit into this dividend stock analysis picture?
Right. ROE, or return on equity, is another key profitability metric, while ROCE looks at how efficiently a company uses all its capital.
Right, the total capital.
ROE specifically focuses on how effectively it's using the money invested just by its shareholders to generate profits. So it's another angle on how well the company is performing financially for its owners. While the video doesn't delve quite as deeply into ROE as ROCE, it's definitely another valuable piece of the financial puzzle.
Okay, so we're looking at profitability, efficiency, how the market values it. What about the actual business itself seems important?
Oh, absolutely crucial. The video emphasizes that you can't just rely on the numbers alone. You need to do a bit of, let's say, detective work on the company itself.
Okay.
Look at its past performance. Has it been a consistent dividend payer? What exactly does the company do? Understanding its business model, the industry it operates in, that's critical for assessing its long-term prospects and, crucially, the sustainability of its dividends.
Right.
And also, who are the major players? Understanding who the promoters or major shareholders are and their stake in the company can also provide some valuable insights.
And I guess it's not enough to just look at one company in isolation either.
Precisely. You hit on a key point there. The video highlights the importance of comparing a company's dividend yield and those other key metrics against its direct competitors, its peers within the same industry.
Okay.
This peer comparison can give you a much better sense of whether a company's dividend and financial health are truly attractive relative to the other players in its field.
So to really make this concrete, the video actually walks through several examples of actual stocks and applies these criteria. Let's maybe look at some of those. First up was ICICI Securities.
Right. For ICICI Securities, the video points out a PE ratio of, I think, 14.88, a dividend yield of 3.28%, and an ROCE of 20%. So based on those numbers, it appears to be a potentially interesting option. It meets several of the criteria in that custom formula and shows good profitability.
Okay. Then they analyzed Indian Metals. That one had a very low PE, 9.82, and a dividend yield above 2%. Sounds good initially, but what was the potential red flag the video highlighted there?
Yeah, the critical point with Indian Metals was its negative quarterly sales growth year on year. And this really underscores the importance of not just focusing on a low PE and a decent dividend,
Right.
a decline in sales. Well, that could be an indicator of underlying problems with the business, which could eventually impact its ability to maintain those dividend payouts. If you think about it, a healthy dividend often comes from a company that's actually, growing its revenue successfully.
Good point.
Oh.
Next on the list was Glenmark Life. It had a PE of 29, dividend yield above 2%. What were the concerns raised there?
With Glenmark Life, the video noted negative quarterly profit growth and also lower quarterly sales growth compared to some of its peers. So, while the dividend yield might have looked acceptable on the surface,
Hmm,
the lack of growth in these key financial indicators made it potentially less attractive than maybe other companies with stronger growth prospects. It makes you think about your priorities, right? Are you primarily after current income, or are you also looking for companies with good growth potential?
that's a key trade-off. Okay. VST Industries, a company in the cigarette sector. It had a PE of 23.7% and a pretty good dividend yield, 3.58%.
Okay.
But again, there was a reason for caution mentioned.
Yes, VST Industries also showed negative sales growth. So even with that appealing dividend yield, the fact that their sales were declining suggested potential future headwinds for their profitability and overall growth. According to the video's analysis, that made it a potentially less desirable dividend stock.
Yeah.
It's a great example of how a seemingly attractive dividend can sometimes mask, underlying weaknesses in the business.
Okay. Even a really well-known company like ITC, PE of 31.64, dividend yields 2.68%, prompted some discussion. What was the point there?
Well, the video observed that while ITC offered a reasonable dividend yield, its profit growth wasn't particularly strong. It wasn't bad, but not high growth. This just illustrates that there can be trade-offs between the size of the dividend and the company's growth potential. A more mature, stable company like ITC might provide consistent dividends, but it might not offer the same level of rapid growth as, say, a younger, more dynamic company.
Right, different profiles. Then the video shared a couple of examples that really focused on quarterly profit and sales growth as filters Andhra Petrochemical and Majestic Auto. What were the key takeaways from those?
Yeah, those were interesting. Andhra Petrochemical showed good growth in its quarterly profits, but its quarterly sales growth was actually negative. So based on that specific criterion, it got filtered out.
Okay.
Majestic Auto, on the other hand, apparently stood out. It had a low PE of 11, a dividend yield of 3.5%, good profitability, and strong sales growth. This really highlights the power of using multiple filters to try and identify potentially undervalued dividend-paying stocks that also have good growth momentum.
That seems like a good combination.
It does. It's worth noting, though, that while Majestic Auto's dividend yield was appealing, the video excerpt we looked at didn't specifically mention its ROCE being above that preferred 20% threshold. Just reminds us again, the need for thoroughness in checking all the boxes you set for yourself.
Absolutely. And all of this really brings us back to that fundamental principle, doesn't it? Doing your own thorough research. The video makes a really good analogy to buying property.
Exactly. You wouldn't buy a house or an apartment based solely on a flyer or, a quick look from the street, would you?
No way.
You'd conduct inspections, review all the paperwork, do your due diligence. Investing in stocks, even these dividend-paying ones, really requires that same level of careful investigation and analysis.
And a really important disclaimer from the video, and one we absolutely need to echo here, is that this is not financial advice. We're just exploring how to approach analyzing dividend stocks based on the information shared in the source material.
That's absolutely right. We're not recommending any specific stocks mentioned here or otherwise. It's always really essential to consult with your own qualified financial advisor and conduct your own in-depth research before making any investment decisions.
Definitely. Okay, let's try to synthesize all of this. What are the main things we should take away about generating regular income from the stock market through dividends based on our deep dive into this video?
I think the key message is definitely this. Don't get fixated solely on a high dividend yield number. It can be tempting, but don't do it.
Right.
Instead, adopt a more comprehensive sort of multi-factor approach. This involves looking at the dividend yield as, yes, a starting point, but then critically evaluating the company's profitability using metrics like ROCE and ROE, assessing its growth, both in profit and sales, and considering its valuation using tools like the PE ratio. And as we discussed, utilizing those stock screeners to create your own customized filters based on these kinds of criteria can be a really effective way to narrow down your potential investment options from the huge universe of stocks out there.
Okay, that's a great summary. So what does this all mean for you, the listener? Well, here's something maybe to think about. Beyond just the immediate income that dividends can provide, how can understanding these fundamental factors, the ROCE, the growth, the valuation, how can that help you identify companies with truly sustainable growth and long-term value? Companies where those dividends are just one part of the puzzle, just one of the ways they reward their shareholders. It's really about looking beyond that initial payout and trying to understand the health and the potential of the underlying business itself.